All right. Good morning, everybody. It's Michael here again with the second installment, as promised, of the supply and demand report, where we started the discussion on assessing the quality of zones last week. It's the 11th of April, and I'm going to go over today an idea that was shared on the roundtable before it happened, and the trade is in management already. But to go through the concepts that we discussed in last week's video on how to assess for the quality of a zone. So let's go through it. Now, I was looking at this zone, but some of my colleagues and friends on the roundtable were already in the nat gas trade from that level at the upper level there. So today I'm going to talk to you about this level, but the same principles apply for whatever level you're looking at, including this one, whether that's in Forex, in futures, or in stocks, or whatever the asset class that you are trading. So I've left some of the notes from last week's lesson, which I understand some of you found really useful because you emailed me about that. So I've left. We're going to go through that. We're going to use that to go through the idea, and let's get into it. I don't want to make this video too long, so I don't lose some of you. Okay. So we started off last week talking about assessing the strength of the move away from a zone, and we talked about the gap away from a zone being the ideal or the biggest representation of an imbalance. The second alternative is leaving away by really large candles in a fast, decisive manner. And the other way is a slow, more labored, sort of limping departure from a zone. So on this level, when I found it and pointed it out to the members of the roundtable, we assessed the move away as being quite strong. This is a large candle, and I'm just going to blow that up so you can see it. I hope it's coming through clear. So we have the big move away after a period of basing. We'll talk about the time spent at the level as part of the quality assessment, but let's stay with the move away. So not only did we have that move away being a large candle, we also followed it with a gap down that continued and got all the way there. Remember, we also talked about distance moved away from the zone before it returned to it. Well, that's measured here. Now, just for those of you who may not be aware, TradingView has got this Fibonacci measuring tool that is really, really useful in terms of measurements, putting in zones, and you can customize it as much as you want. So I've customized some of mine, and I have different templates just to make my workflow easier for me. So if I wanted to assess, for example, the distance moved away, I can do that easily, and I'll show you how to do that. But for now, move away is by a big candle, a gap, even another big candle. Okay, so if I was going to score this, I would lean to giving it a very high score. I wouldn't give it the maximum score because the move away from the zone was not via a gap, but it would be a very close second what I would give it. It did have a gap away, but the move had already happened from the zone before this gap took place. So I'm not going to use this gap as the move away from the zone because it's not. The big candle here is the move away from the zone. So that's large enough for me. It's good that it was followed by a gap down, and it's even better that it continued even further down. So second highest score, as I said last week, you can decide whatever score you want that to be. If you'll move away via a gap, if you say it's 30, then you can say this kind of scenario where you have big candles, even if you include the gap as a sort of make it one whole big candle in your mind's eye, maybe you score this one a 25 or a 20. There is leeway. There's no conscription. You're not boxed in by that. There is leeway as long as I said, you can differentiate in your mind what's the best looking scenario versus the, good scenario, the okay, and then the stay away from kind of scenario. Okay, so that's got a high score for that. Okay, so the next point we were looking at, if we go up and bring those notes back, so you see gap away we said is the best scenario. Large candles, so that this one we just assessed would fall under number 2, for example. Okay, and the next point then we want to assess is the amount of time prices spent at the level. Okay, so let's go back to that. How much time, how many candles did, how many periods, did price stay at a level before the move away, not including the move away, before the move away. So this formation, as most supply and demand traders know, would be referred to as a drop in price, a period of basing, followed by another drop. A continuation pattern. Continuation pattern for what? A continuation pattern for an existing trend. Okay, so look at the number of candles before this move down. 1, 2, 3, 4, 5. I've included that one. That's just me. That's my quirk in the way that I draw my zones. I like to have mostly basing candles. You could have done that. Absolutely nothing wrong with it. Absolutely nothing wrong with it. Okay. The idea of supply and demand zones is for you to identify where the order flow primarily took place, where the majority of the order flow took place before a decisive move, either up or down. Okay. It's not to box you into, hard and fast rules that you can never get out of. No. Okay. So 1, 2, 3, 4 or 1, 2, 3, 4, 5. It's still within our, we said 6 candles at the max. And then we also said you could break that up into whether you wanted a sweet spot sort of thing where you had 3 to 4 candles as your ideal scenario. Then 5 to 6 would get the second highest score, and then 1 to 2 may get a lower score. Whatever you want to do. But the rule of thumb, and it is a rule of thumb, is 6 candles at the most. So this zone, in terms of time spent at the level, would score really high. So you could give it your maximum score. You could give it your second highest score as well. Okay, so next point on the list. Let's bring that up. I hope I'm not making too many of you too dizzy. But I just want to be able to show you the point and then go back to the chart and show you what I mean. So we've talked about the amount of time spent at the level. We've just discussed that. How far did prices move on departure away from the level before they came back to the level? So let's go assess that now, and we will see what that looks like. Okay. So we're talking about the distance moved away by price before it came back. So this is what we are referring to. This distance from your proximal line, from your entry line, from the line closest to price as of the time you are assessing the zone. You're measuring the distance traveled away from the zone, how far it went to the last tick before it came back to the zone. So it is this distance here. Let me bold that up so you can all see it a bit. So this is the distance. This one here is the one that you are assessing. Not this one. Not the move back to the zone. You are assessing this distance from the zone. How far did it move? Now, as I said, TradingView has the Fibonacci tool that you can use to measure those distances and make your life easier. You can have templates, which I do, just to make my workflow easier, as I said. So I will show you what I mean. So I've got that there, and I have that measurement, which will then reverse to help me measure. So I've got my zone 0 to 1. So that represents the zone. Now that represents a distance of one time the size of the zone. Where you have the 2 there, it's very small, so you may not be able to see it. Maybe I can make it bigger. Let me see if can I make the numbers bigger. I don't think so, unfortunately. Maybe if I make the lines thicker, will the numbers become bigger that way? No. Okay, so I hope that you guys can see it clearly, but I'll show you how to customize the Fibonacci measuring tool in a second. But the 2 here you see is 1 time the size of the zone. When you see 3 here, that's 2 times the size of the zone. 4 there represents a distance that is 3 times the size of the zone. And we can see that when prices left this level, they didn't move a distance 3 times the size of the zone yet. Yeah, before prices returned, they hadn't moved 3 times. They had moved just over 2 times the size of the zone. You know, that is the minimum requirement. As we talked about last week, we said the minimum requirement for a quality zone is that the distance prices move away from the zone is at least 2 times the size of the zone. So this zone here would meet the minimum criteria that we have set. We've set that arbitrarily. Like I said, some of you may prefer to take zones that have 3 times as your minimum. 3 times the size of the zone as your minimum, which is absolutely fine. You will get less zones that will meet that criteria, meaning you will be trading less, but you will have quality. So it depends on what you are looking for. If you're looking to be able to trade more frequently, which has its pros and its cons, of course, its advantages and disadvantages, then a minimum distance moved away of 2 to 1 will give you many more zones on a price chart than if you were looking for 3 or 4 or 5 to 1 as your minimum. I hope that is clear. So the minimum criteria set for a starting point is 2 to 1, and this zone meets that criteria. Okay, so in modifying this Fibonacci tool, I'll just show you what it contains. So you have the 0, you have the 1, and then you just do 2, 3, 4, 5, 6, as many as you want. You can do it for as many boxes as the tool will allow you. So I've done it up to 10, for example. Not that, you know, I'm looking for zones that have a move away of 10 to the size of the zone, or 9 to the size of the zone, but just my I could take it off. It don't get bogged down by that. I could take all of those off and just leave that. So you have, that will mean 4 times the size of the zone, because the zone itself is 0 to 1, and you'll have 1 time, 2 times, 3 times, 4 times the size of the zone. I hope that is clear. So just a little trick for you for modifying the Fibonacci tool there. So we'll go back to our regular zone tool, which is this one. So you can see we've talked about, to summarize so far, we've talked about the strength of the move away, big candle followed by a gap, another big candle following that, big move away. Will probably not get a maximum score because it's not a gap, but it will get a very high score. Next, we talked about the time spent at the level. We said it's at least 4, maybe 5 if you drew yours like mine. It also scores a high level because we talked about 6 being our sort of rule of thumb tipping point. Okay, then we've just measured how far prices moved away from the zone before they've returned to the zone. So we've said that that has met the minimum criteria of a move at least 2 times the size of the zone. Okay, and I've just shown you how you could modify your Fib tool to get that easily, so you don't have to be checking numbers and measuring by hand, so to speak. Okay, let's move on to the next point really quickly. So the next point we're looking for, we've talked about how far prices move away. Next point we say is, did the departure from the zone result in the removal of opposing orders? So an opposing level. Yeah? Okay, let's go look at that. did the move away from the zone remove an opposing level? Now, to do that assessment, you are going to be looking left at everything below the proximal line. Everything from this point, from this entry line, from this line where that was closest to price, you will be looking to the left. So actually, you will start from here and you are looking down and left. You are looking to see if there are demand zones in this case, because this is a supply zone. So you are looking, did this move in price that we got all the way to down here, did that remove any demand zones to the left, which will increase the strength of this zone in that it was able to remove a stack of orders opposing it. Okay, so what you guys think? Did it remove? So here's a zone. Here's a zone. Did it remove that zone? No, it didn't. And if it didn't remove that, obviously it didn't remove that or that. But wait, remember what we said, that the biggest representation of an imbalance is what? A gap. Okay? For those of you who have not seen it already, I'm sure some of you have already, but prices closed here. And what did they do the next period? They opened here. This is a gap, ladies and gentlemen. The biggest representation of an imbalance that we have within the methodology, the timing methodology that we use, is right here. Prices closed here, they gapped up and opened, and they moved high off. So this zone was clearly removed by this move in price. It doesn't look like our usual patterns that we look for, you know, the rally-based rally, drop-based drop, and all that. This zone doesn't really look like any of them, which is why it's important for us to also look at price action. Supply and demand is primarily a price action based methodology as it is. So we would have missed that if we didn't look at the price ladder and look at the structures that were being created. So this had a significant gap up. So this would meet the criteria of removing a zone if you made that assessment. Okay, so that criteria is also met, that it removed an opposing zone. And remember, all of these assessments are blended into one to give you a score. Some are slightly more important than others, but what is most important of all is the final score that you get. And you set thresholds. If you will only take zones that are scoring, say, 7 out of 10, then that will be that. If you get a zone that is 6, 6.5, maybe you traded but not with your full position size, that type of thing. You are a trader. You're not boxed down to one methodology. You adapt your skills. You try something a few times. You get enough of a sample size, and then you run with it. That is how I've developed. That's how my traders, my friends have developed. That's how I would encourage you to develop. Don't get bogged down with, well, the methodology says I can only take this or I can only do that. You test things. If you say I'm only going to take trades that are 7 out of 10 and you stick to that, that's absolutely fine as well. You may decide, you know what, I want the quality and only the quality. I don't want to mess about with, if this, then that type of scenarios. I want to be very dogmatic about it. I want clear, set in stone rules. Then go with that. But stay with that if that's what you decide. And then evaluate it. If it works, great. If it needs tweaking, don't be afraid to tweak it. The important thing is that you have a solid foundation, which I'm hoping that some of these videos will help with. Then you build, whatever you build on that foundation, have a reason for it, understand it, but your foundation stays solid, okay? I don't know why I went into that sort of monologue, but yeah, I don't know. I go into some of those things sometimes. Okay, so we've talked about, did it remove an opposing level? We found a gap and we found that it did do that. Now, how deep prices penetrated a zone on its return as of the time you were assessing it. So let's go back to our zone. So this is assessing freshness, and that will be the last one that we'll talk about. As I said, there are other assessments that need to be made, but we are looking solely in these videos at the structure of the zone itself. What assessments that have to do directly with the zone itself. Okay. So we're talking about freshness. So obviously, as of the time this zone was being assessed, it was fresh. Prices had not returned to it at all. So it got a maximum score for that. It was a fresh zone. Prices had not returned to it as of the time we identified it. And so you would give it a maximum score. Okay? So that's how you would assess freshness. You would look at the zone and you would look to the right. Often a lot of the things we do when assessing and drawing zones is we're looking to the left. With freshness, you are always looking in that direction. You're always looking to the right of the zone. Not to the left, you're always looking to the right to see, have prices returned to the zone? If they haven't, that's best scenario. If they have, by how much have they penetrated the zone? So you could see here, this penetration into the zone was just under 50%, I would say, of the zone. And again, you could just modify a Fibonacci tool to do that measurement. In fact, let's do that and see for sure. So if we have 0 and 1, if we then put, say, 0.5, if we put 0.5 and see where that line goes. So there you go. And I'll make that let's make it a white. Okay, so it can bold, we can see it clearly. Let me take out that arrow. Let's take out that arrow. Will it let me? I want to take out the arrow, but never mind. So you can see where 50% is anyway of the zone right in there. So prices haven't returned to 50%. They've obviously gone beyond 25%. So you might, if you were assessing this zone today and you think, this zone, I might want to take it again. Let's assess the quality of it. You would not score it as high as when the chart was like this. Prices had not returned to the zone when the chart was like this. But as you move forward, now that prices have reached the zone and penetrated it, the penetration hasn't been 50% of the size of the zone as you drew it yet. So you won't give it the maximum score. You may want to give that zone, you will want to give the zone a lower score than it would have gotten if it was still fresh. I hope that is clear. Remember, when you're assessing for freshness, you're always looking to the right of the zone. You're always looking to your right in this direction. Okay, so I believe that is all. How long has that video been now? I don't even know, but I hope it's not too long for you guys. And I hope it's been helpful. Just one practical application of it. Where did that thing go? There we go. So we've assessed all of those things. Remember, try not to be too dogmatic about it. Have a sort of structure that you understand that works for you, using this as your foundation. Okay, so I hope this helps. Look after yourselves, trade well, trade safe. And just to show you, that's the zone that we talked about. That's the zone, and that's one of our traders. This is the round table, the Discord version. That's the trade there, and he was saying that it worked like a charm, and he was already in it. He was actually already in that trade from that zone up there. So these are the kind of discussions we have, and that's me up there posting the zone that I just discussed with you all. This was in the futures market that it was taken, not the CFD one. Okay, so that's that. I hope it's useful for you guys. Of course, you have my details if you wanted if you had any questions, if you wanted your questions answered on how to access mentoring, or you wanted to learn more deeply about supply and demand and about trading, because as I said, I'm very keen for you not to be boxed in by a methodology. Supply and demand doesn't need disciples. You're traders, we're all speculators. Okay, so storehouseanalytics@gmail.com if you wanted to send me an email to request information on the mentoring. And hopefully we will resume our sort of quarterly webinar series. I'm preparing for that, trying to get the dates sorted and into my schedule. And once that is all set, of course, I will announce it in the videos. It's just an hour-long meeting where we meet to look at charts together, not me just going through charts. We talk about trading, we talk about ideas, we talk about different methodologies, that kind of thing. Okay? But supply and demand as a timing tool is still our foundational tool for sure. Yeah? All right. I'm going to love you and leave you guys. Thank you all for watching the videos. Thank you for sharing them with your friends and social circle. And if you do like it, please remember, I'm told we need to be saying this. Oh, I need to be saying this more often. Please give it a thumbs up if you enjoy the content. If it's absolute rubbish and you hate it, give it a thumbs down. Okay. Thank you, everybody. Take care now. Bye for now.